Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, heading into today's open. Futures are clinging to highs, but a hawkish Fed pivot overnight triggers a violent rotation. Watch for a battle at the bell as smart money flees tech and floods into forgotten sectors. Is this a healthy shift or a market massacre in the making? Second, Fed's civil war exposed. Leaked minutes reveal a historic internal battle as a hawkish takeover looms. The Fed put is officially dead, triggering unprecedented uncertainty. With new hawks rotating in, will the market finally price in the no landing scenario at the open? Finally, silver skyrockets as China weaponizes exports. Physical metal premium soars $10 over spot overnight, igniting a global supply crisis. This isn't just a commodity surge, it's a de-dollarization power play. Which green energy stocks and silver miners will explode or implode at the bell? Warning, the era of easy money expectations just hit a brick wall. The Federal Reserve isn't just pausing, they are actively dismantling the aggressive rate cut narrative that fueled the 2025 rally. While the indices are sitting near all-time highs, the tectonic plates beneath the surface are shifting violently, and the market is scrambling to price in a new reality for 2026. The S&P 500 closed the year near 6,888, clinging to gains of over 17%, but do not let the headline numbers fool you. The Nasdaq Composite has shown distinct weakness in the final sessions, struggling to hold its momentum. We are witnessing a divergence where the index reflects calm, but the internal capital flows are chaotic. The smart money is rotating out of duration-sensitive growth stocks and aggressively positioning into sectors that benefit from a higher for longer rate environment. The catalyst for this upheaval is the release of the Federal Reserve's December meeting minutes. We saw the highest dissent rate within the committee since 2019. It is a divided house, but the real cold shower for the bulls came from Chair Powell's assertion that rates are now within the broad range of neutral. The futures market reaction was instantaneous. The probability of a rate hold in January 2026 has spiked to nearly 85%. The market was betting on a continued easing cycle to justify elevated tech valuations, and that bet just got taken off the table. Why does this matter right now? Because the 10-year Treasury yield is firming up around 4.12% and threatening to push higher toward 4.30%. This creates a hard ceiling for equity valuations. When the risk-free rate offers a competitive return against the S&P 500 earnings yield, the premium investors are willing to pay for risky mega-cap technology stocks evaporates. Analysts point out that the current forward P/E ratio of over 22 times earnings assumes rates will fall. If rates stay sticky above 4%, that valuation math simply breaks down. This brings us to the massive rotation we are seeing in real time. The Magnificent Seven trade is losing its absolute dominance. Alphabet is up over 60% for the year, an incredible run, but valuation concerns are mounting as experts question the timeline for AI monetization. Meta Platforms is facing similar scrutiny regarding its massive capital expenditure plans. The market is asking a simple question. Where are the profits to justify the spending? Conversely, capital is flooding into areas the market ignored for the first half of the year. Utilities, traditionally boring, defensive yield plays are being repriced as the critical growth engine for the AI revolution. You cannot build data centers without massive power, and companies like Constellation Energy are surging as investors realize they hold the keys to the grid. Financials are also bidding up. Major banks and financial institutions typically see their net interest margins expand when rates stay elevated, making them a prime destination for funds, leaving the tech sector. We also have to talk about gold. The metal is up a staggering 147% this year, reaching levels around $4,400. This is not just an inflation hedge. This is a signal of deep systemic hedging against policy error and currency debasement. However, with such a vertical move, market observers warn that profit-taking could be imminent as portfolios rebalance. The most alarming signal, however, isn't on the price board. It is in the breadth data. The advanced decline ratio has slipped below 1.0 for 2 consecutive months. This means that even as the S&P 500 hits highs, more individual stocks are falling than rising. This divergence is a classic late cycle warning. It suggests the rally is thinning out, relying entirely on a shrinking group of heavyweights to hold up the index. The market is transitioning from a momentum game to a valuation discipline game. The playbook that worked in 2025, blindly buying tech dips, is facing a severe stress test. With the January employment report and CPI data looming just days away, volatility is priced dangerously low. The narrative has shifted from how high can we go to how much yield can we lock in. The next few sessions will determine if this is a healthy consolidation or the start of a broader correction. Keep your eyes on the 10-year yield. That is the scorecard for 2026. Heading into today's open, newly released minutes from the Federal Reserve's last meeting reveal a central bank deeply at war with itself. You know, these minutes are the detailed records of the Fed's private policy meetings, released 3 weeks later, and traders scrutinise every word for a rare glimpse into the true debates among the world's most powerful financial figures. While the headline was a quarter-point rate cut, the real story is the division behind the scenes. The official 9-3 vote was the most split decision since 2019, but the private debate was even tighter. The minutes reveal that a few officials who voted for the cut admitted the decision was finely balanced and they could have easily supported keeping rates unchanged. It basically puts names in quotes to that internal three-way split we've discussed before between cut, don't cut, and cut even more. This is where the situation takes a more complex turn for the market. For years, investors have relied on the so-called Fed put, the belief that the Fed will always step in with rate cuts to save the market. But these minutes show that safety net is no longer guaranteed. The deep division makes the Fed's reaction unpredictable, which could inject a lot of volatility into stocks. The situation presents a fascinating duality. One faction fears a slowing labour market, while the other is sounding the alarm that progress on fighting inflation has completely stalled. The core conflict is between supporting the economy and killing inflation, and the Fed itself doesn't know which threat is greater. This echoes the historic tug-of-war we've tracked, swinging from the jobs-first 1970s to Volcker's inflation fight in the 1980s, and today's minutes show that same fault line running right through the committee. Both sides have a point, actually. The faction worried about jobs can point to leading indicators like the JOLTS report showing job openings are declining. This suggests the labour market is cooling, giving them a reason to cut, and this connects to those payroll revisions we flagged, the kind of thing that made Powell worry the jobs picture was softer under the surface. But the other side sees inflation still well above the 2% target, holding around 2.7% as we've noted, which keeps the pressure on. And here's where it gets interesting. This battle is about to get even more intense. 4 new regional presidents are rotating into voting roles, and several have previously expressed strong opposition to rate cuts. This personnel shift takes the idea we've discussed that leadership changes can tilt outcomes from theory into a very near-term risk. Several of the incoming voters are known hawks, prioritising fighting inflation with higher rates. This raises the bar for any future rate cuts and sets the stage for a potential hawkish surprise. Now, get this. There's a potential blind spot in the inflation data. Tariffs. While the Fed often dismisses the impact of tariffs on Chinese goods, recent research shows this cost is almost fully passed on to US consumers. It's a point we've dug into before. Tariffs aren't a one-off. They've likely added to CPI and are accelerating supply chain shifts, risking a kind of durable trade block style price pressure that the Fed can't just ignore. It's exactly the stagflation setup we've been watching. The bottom line for today's open is that the market can no longer count on a unified Federal Reserve. This internal fracture means future rate decisions are now highly unpredictable. So, what should we watch? First, look for nervousness in the stock market. This uncertainty is kryptonite for confidence. So watch for selling pressure on the S&P 500 and the NASDAQ 100 ETF, QQQ. Second, keep an eye on the 10-year Treasury yield. If the market starts pricing in a more hawkish Fed, that yield could climb. From now on, every major economic report is a high-stakes event. Speaking of pressures, the Fed can't easily control. A major economic showdown is brewing that could tie their hands even further. China is officially tightening its grip on silver exports, a metal critical to US industry and defense. Most people think of silver for jewelry or coins, but its real importance is industrial. According to the Silver Institute, its use in manufacturing hit a record high last year, driven by green technologies. Every solar panel and electric vehicle uses silver for its unmatched conductivity. This means the green energy transition, a core part of Western policy, is directly in the crosshairs. This builds on a trend we've been flagging. Silver's outperformance was already signalling a mix of safe haven demand and real industrial pull. Today's move turns that signal into a policy shock. This comes as silver prices have more than doubled this year, on track for their best performance since 1979. According to an industry insider, Beijing's new policy formally elevates silver to a strategic material, putting its export controls on the same level as rare earths. If that strategy sounds familiar, it should. By invoking the rare earth playbook, China is signaling it's willing to use its dominance in supply chains as geopolitical leverage. This forces US and European companies to urgently rethink where they get their materials. However, if you zoom out, you'll see another layer at play. Some research suggests this could be a defensive move to hoard silver for China's own massive ambitions in solar and defense. This implies the global silver shortage may not be a temporary tactic, but a long-term structural reality, which helps explain that sticky geopolitical risk premium in gold. We've mentioned Tesla CEO Elon Musk posted a direct warning about the restriction, stating, "This is not good. Silver is needed in many industrial processes," and he's right to be concerned. Research from the Silver Institute shows an average EV can require up to 50 grams of silver, and solar demand is projected to hit over 260 million ounces this year. This supply shock could feed directly into core goods, inflation, complicating the disinflation story for the Fed, a challenge we've noted was already intensified by strong industrial demand, and the pressure is already showing. The CEO of one Canadian silver company confirmed that buyers from China and India are offering to buy physical silver for as much as $10 above the spot market price. That $10 premium for physical metal, that's a massive red flag. It shows a major divergence between the paper market and the real world, suggesting industrial users are so desperate they'll pay far more for actual physical silver. The fear is that this could lead to delivery defaults on futures exchanges, creating financial risks similar to the 2022 nickel crisis. But this isn't just about one metal. One economist is calling the surge in silver and gold prices a flashing warning for the US economy, as the US dollar index has fallen by nearly 9.5% in 2025. After all, central banks around the world, especially China's, have been buying gold at a historic pace. This aligns with a theme we've been tracking. The World Gold Council has reported massive central bank purchases for 3 straight years. Many see this as a strategic move to diversify reserves away from the US. Dollar. So this could be a sign of a structural de-dollarization trend where global investors increasingly prefer hard assets over fiat currencies. So with China squeezing supply, what should we watch at the open? First, look at the shares of silver mining companies and ETFs. Second, keep an eye on industrial stocks, especially in the green energy sector like the Invesco Solar ETF, ticker TAN, as they could face immediate margin pressure. Finally, watch the price of silver futures and the US dollar index to see if these trends accelerate.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.